This is Jeremy Wentworth-Stanley. I'm the fellow who has a hyphen in my name. The hyphen is silent, but I am anything but that. Respectonomics brings you Living Economics. And Living Economics is a portrayal of current economic conditions and talks about things that are happening in the economy today. Your speaker is Jeremy Wentworth-Stanley. I am your voice of Respectonomics. I'm also your ear of Respectonomics, so that if you have feedback or you want me to be aware of some things or you want to ask me questions, jeremy@respectonomics.com is where I do my listening. So a voice at one side and a ear on the other. And what we're going to be sharing today about is the stock market. Now, before we go any further on the stock market, this is not intended to be a recommendation of any shape or form. I say that for two reasons. One is because it's not going to be that, but also we need to be able to have people go and talk to professionals when it comes to advice on how to invest and which stocks to buy or sell or whatever. But that is not included in this discussion. This is more of a discussion of understanding what the stock market is, what its function is, and what it's, generally speaking, what it's reflecting. The stock market today is one of the, shall we say, the most obvious places where one can invest money. There's all kinds of places we can invest. You can invest in real estate, you can invest in collectibles, you can invest in coins, invest in paintings. The list of where we can invest is significant. We're just talking here about the stock market. And there are a few things about the stock market that I think are worth knowing about. And the first one is that the stock market allows us to invest pretty much in any kind of industry in the world, any kind of business, whether it's technology, whether it's mining, whether it's banking, whatever it would be. But there's a tremendous variety of the types of businesses one can invest in. And secondly, we can now invest internationally as well as domestically. So wherever you are, there are rules about how you invest and so on. And I don't want to go into the rules particularly. I want to talk about the stock market, though, from another point of view altogether. And the stock market today is reflecting much higher prices. And we need to look at those higher prices and ask ourselves, what is the basis of those higher prices? And there are three reasons why the stock market has been experiencing rising prices. One of them is a very, very straightforward function, and that is that the earnings, the profits of corporations have been rising, and the stock market is very good at recognizing the growth in earnings or profits. The stock market is like a barometer. It effectively measures, it's a measuring device, and it measures, if you think of a barometer, that is measuring air temperatures and pressures. But the barometer in the stock market, or the barometer of the economy, is the stock market. And what it does is it basically measures the efficiency of the use of capital. If capital is being used efficiently, it will tend to raise prices up. Now, there's no one single reason for a price to go up or down, so you need to be able to look at several factors. We do that in our lives. We look at several things that influence how we do. There's never very unusually, is there a single one-line answer. But corporate profits are one of the things that lead to different prices and fluctuations. Again, if the earnings are doing well, it will tend to be a bias on stock prices to move them up. Not an absolute, but that's the general pattern. So you've got, the first thing you've got is this increase in profitability, which translates into higher prices, and that's intended to be a proxy on the use of capital. The second thing is that companies are in the habit of taking each other over. So you find one mining industry taking over another, you see airlines, one taking over another. And whenever you see this, you do see this concentration of wealth. Now, there's a number of opinions about this concentration of wealth from a social point of view, moral point of view, ethical point of view, about how concentrated wealth should be. But when you have two or three corporations that are blended into one, the math is fairly straightforward, which is that the money available for investment can only now go into one investment instead of what was before that three. There used to be three businesses you could buy, now there's only one. So that as we see the process of consolidation, as we see takeovers happening and mergers and so on, as these acquisitions take place, this concentration takes place. As the concentration takes place, the same amount of money is available to buy them, but because there's a reduced supply of securities, that tends to drive up the price as well. The third thing is that we need to think about is that the stock market has also become almost like an anchor to the supply of money. Now, let's take a look at the supply of money. The supply of money is, roughly speaking, determined by a central bank. A central bank issues or allows money to flow into the system. It's done usually through credit. If you think about it, that when someone goes and borrows money from the bank, they borrow $1,000 or $10,000 from the bank. That credit is effectively new money that is now injected into the money system. That's one part to it. But government deficits are another reason as well, that as government deficits rise, as indeed they have been doing, what then happens is there's more money in circulation because that deficit is being financed. It's a gap in the money system. There's not enough money to do whatever it is we want to do, or at least governments want to do, or we want governments to do. So what we do is we then start running these deficits, which means that whatever that shortfall is, the money has to be made available to do it. I mean, otherwise it won't happen. And the money comes into the system. So government deficits are, in a very practical way, a way in which the money supply is increased. Now, it may seem unusual that one would be looking at the stock market in correlation to money supply. But if the money supply is expanding and money doesn't have what you would call a natural anchor, it used to be that the anchor to money was a gold standard. In fact, the original currency, the original issuance of currency was convertible into gold. That stopped in the 1930s, and then later on, in 1971, it was then thought that came about that money was in fact no longer backed by a single commodity, it was backed by the total net worth of the economy. And that has great advantages, but it also has a disadvantage, and that is that the money that's in circulation is also a result of where governments can effectively write the check. They can write the check because the money is in the till. The reason the money is in the till is because the central bank has made the money available, and at the same time has produced an IOU. So when you hear a government bond is an IOU. It is then bought by the central bank. The central bank then owns the bond, and the money is now in circulation. Money is something that's always looking for a natural anchor point. It's almost like looking for a safe harbor. And as people want to do that, it's a sort of almost an invisible process. But as people look to see what are they going to anchor it to, real estate has been one way in which money has been anchored. And we can all see how the price of real estate has risen faster than the natural growth of the economy. We also see that the stock market has been rising more specifically than the total economy. And the reason for that, of course, is that the money has been able to go into a market where there are fewer securities, relatively speaking, to the supply of money, which tends to drive prices up. Not only that, so not only are we dealing with almost like you to say a plumbing exercise, where fewer securities, more money, up goes the price of the securities. If you go into a grocery store and you've just had payday and everybody else has had payday, you can see the price of groceries moving up just because of that. But the other catch here is this, that the money is looking for an anchor. And one of the great advantages of the stock market is liquidity. One of the disadvantages of real estate is illiquidity. So in other words, if real estate becomes the background for the anchor point for money, it's also in certain conditions difficult to sell. You can't just go and say, I'll sell the farm, I'll sell the house, I'll sell this piece of property. So whatever it might be, it can be illiquid, whereas the stock market, its great clarion call is the fact that it's liquid. You can buy and sell at any time. So what's been going on is the market has been rising because of these trends. The trends of the improving profits, the trend of consolidation, meaning that you've effectively reduced the supply of securities, and then the overburden, if you want to call it a burden, but the oversupply of money that not only has driven up the prices because there's more money than stocks around, but also at the same time, the money is looking for that anchor point, that place where it feels that it's got a home to which it can actually relate its own value. And this is all what you might call interesting economic chat. And the problem we're up against is that we need to look at the stock market in the context then of the government deficits. And government deficits, which we're going to be covering in another living economics rollout. But one of the things we have to come to grips with is if governments go on with this deficit financing, it will likely have an upward bias on stock prices. On the other hand, if governments start pulling back, which will happen when in fact when governments recognize that the interest payments are ballooning beyond what they can afford, if we see a time of pullback, you might call it a recession. But if you see a pullback, what will then happen is as the deficits are reduced, relatively speaking, as they are reduced, then that in effect might reduce the supply of money. There's also the question then of the consolidation that goes on between one company and another. And there's an undergirding feeling, not necessarily legislation, but an undergirding feeling that the concentration of wealth has certain sociological issues with it that may not be healthy. In other words, concentration of power can lead to aberrations and misdirections in the way in which an economy can operate effectively. So there's always these things to think about. We can think about corporate profits and how they're going to perform. One thing that is again to be said, this isn't a recommendation, it's not even advisory. If you're going to get advice in the stock market on actually any kind of investment, one of the questions that you can always ask an advisor is, how do you verify your information? You're going to get information that the person says, the advisor says, we should be doing this, that, and the other. And you can ask one question. How do you verify your information for accuracy, consistency, and reliability? And those three words, accuracy, consistency, and reliability, what they mean is accuracy in the sense that somebody has kept a record of their recommendations in the past. Consistency, of course, is that you don't want to see recommendations that have caused things to go up abruptly or down abruptly. You're looking for something likely more stable and more reliable. And reliability, the word we've just used, is how long has this advisory process been going on? If the advisory process has been going on for, let's say, for a year, it is unlikely to be able to give you the same kind of comfort from a reliable process that's been around for maybe 10 or 15 years. There's that question. How do you verify your information for consistency or for accuracy, consistency, and reliability? They're three questions that we should all be asking. This is an outline of the stock market. It's something that in many ways people don't really want to understand or don't understand. They don't necessarily want to be involved in it. But I want us to all then, at the final trump, I want, there's a good word, I want us to take a peek at the ultimate stock market, the ultimate, because you think of assessments, you think of the value of an asset, you think of the value of the earnings, you think of liquidity and things to be bought and sold. You think of all those things in the stock market that matter. You don't have to be an economist. You just have to be somebody who thinks in terms of how you could invest in somebody else's business. But you know, the one business that we can all invest in very successfully and is a stock market beyond comparison is oneself. We are the ultimate stock market. We can assess our own asset value, we can reflect on our earning capacity, and we can think in the way in which we can be responsive to other people's needs, our own needs. So take a look at the ultimate stock market, which is oneself, and give oneself all the credit that is due. One of the risks at the moment is that we're very good at valuing assets and earnings and talking about projections in the future and so on. How valuable it is if we take those same techniques and apply them to our very selves. That's where we can probably see the ultimate in prosperity, the ultimate in hope, and the ultimate in a transaction that is ours to take control of. This is Jeremy Wentworth-Stanley. Thank you for listening, and I rest my case.